Welcome to the 13 Secrets of the Rich or Informed Advanced Video 2. Protections for business owners, entities, trusts and devices. You work hard to make your business work for you. But business owners are susceptible to many risks. Sales risks, product risks, regulation risks, tax risks, lawsuit risks, and many other risks, many of which may very well threaten your survival. We must know how to lessen or contain the risks and protect the business and profits as a going concern. Specifically, we must know how to take monies and profits out of the business, and lock it away for the owner's retirement. In this video I will show you how to do just that. Let's get started. The topic is entities and business operations. First, most of us operate our business in an entity, like an LLC or corporation, whether as a C corporation or an S pass-through for tax purposes. Each is fine. One decisioning factor of which entity we should choose is the timing of the profits or losses. It is common to consider whether you expect to show a loss in early years and need a pass-through loss on your personal returns. Otherwise, if income and growth is expected, we can plan to maximize use of a C corporation for expenses and reasonable salary, medical, life, reimbursement and insurance plans, bonus and pension contributions. Another factor is whether you intend to seek bank loans or credit and need to show maximum revenues, for example, for rental real estate, and whether you can personally obtain same, for basis, and assign same into an S corporation. Other factors include the number of owners and type of ownership or interests, whether equity or just profits. An LLC and Series LLC may have maximum flexibility in that regard, but the C corporation can also fashion various stock capitalizations, using common, preferred, etc. Other factors include segregation of risky assets from less risky assets. By assets I also mean lines of business and lines of activities. What's business integration and segregation? By asset or business segregation we mean putting risky assets or businesses into its own entity to lessen vulnerability of other assets or lines of business. Integration is how we structure entities, trusts and devices for certain purposes. Note: if you only consider tax benefits, your choices are likely to conflict with business, estate, asset, and retirement purposes. Also, you'll likely conflict with substance, and that's the danger zone. All too often, clients and/or CPAs who focus on tax benefits or form run afoul of substance aligned with reality. You must seek substance and not form. The most important lesson, contrary to what you may think, is to analyze your business and life based on its purposes and goals, lines of business and activities, and segregate each into its own entity, trust or device. That's the safety zone. Please think about that. Your structure or plan is only as good as the reality of your substance. Take the time to think that through. It alone is worth the price of admission. The mistake CPAs, lawyers and clients make is to apply a common strategy or structure that actually conflicts with your unique life and business substance. Substance wins, form loses. So, the operating entity choice alone, unless specifically required by a business license or regulation, is not usually destructive to your purpose and goal. For example, an LLC can elect to be taxed as a C corporation or a pass-through partnership. Although these issues are key, the critical structure is equally or more important. That's right, the segregation of the lines of business and lines of activities into its own entity, trust or device, and the contractual relationship among them is critical. Therein lies a level of protection. For example, would you want real estate that you own to be vulnerable to your business liabilities which you operate at that property or office? No. You would want that real estate in its own entity, like an LLC, and the operating business in its own entity, and a contractual arrangement defining that relationship. Also, in some businesses, it's appropriate to have a management or marketing arm in its own entity, with a contractual relationship with the primary business operating entity. In other businesses, it's appropriate to have a delivery service in its own entity shielding each from the other. Another example is the ownership of intellectual property or IP. IP is intangible property like trademarks and patents. IP can be owned by a separate entity and contractually licensed to the operating entity with an automatic reversion clause in the event of lawsuits or creditor attachment. There is often little reason to expose the IP diamonds to creditors of the operating business entity. Note that the different entities and the owners can supply loans, to or from, licenses, use of property, or other value, real or personal property or services to the other in return for consideration, promises or payment of money. The timing of this may also be key. Certain entities may have different tax years as well. Generally, the return of property or repayment of loans are not taxable events. Planning for expenses and taxable income events in various entities is important. You need entity tax planning mid-year, every year. Speak to your CPA about these possible arrangements. It's about substance, not form. It must be real, or it will be attacked. So, what I am pointing out is, the entities, trusts and devices and how they integrate is the key, not just what entity you choose for operations. Understand that in California, foreclosure of the ownership LLC interests, or stock, is allowed, lessening the protection of the charging order. When possible, we would use the situs of an entity in a state that has beneficial charging order benefits such as Wyoming and Nevada. For VC funding goals, or startups, Delaware may be the favored situs. Let's talk pensions, entities, trusts, and devices. It is often advisable to put certain assets or lines of business and activities in various entities, trusts or devices, for example, LLCs, C or S corporations, children's trusts, life insurance trusts, private retirement trusts, IDITs. This is done for asset and risk protections, as well as for tax reduction reasons. Interests of those certain entities, trusts or devices may be assigned to the living trust, to avoid probate, its cost, expenses, and risks. The topic is pensions and the California Private Retirement Trust. In California, to protect cash and retirement property, we have one of the most powerful devices known as the statutory-styled Private Retirement Trust or the PRT. It's not just a pension-holding device or trust. Let's stop here and discuss the PRT as it should be the end goal of most business owners. Why? It's one of the only devices that can legally lock away cash and retirement property even in the face of lawsuits or judgments. Contributions, accretions, and disbursements to and from the trust are protected from creditors by black-letter California law. The topic is converting non-exempt assets to exempt assets. In addition to homestead exemptions which have limited but effective value, one of the most powerful retirement asset protection methods is converting the non-exempt assets to exempt status. This can be done as various ways including by trusts, pensions and, marital or separate, property or transmutation agreements. For example, the Private Retirement Trust, or PRT. The PRT is one of the most powerful devices used to enhance an estate and business plan which protects the cash, wealth, equity, property, or assets transferred into this irrevocable trust for purposes of retirement. The authority of such a trust is a creation of local state statute, which varies state to state, if at all. For example, in California, under its Code of Civil Procedure Section 704.115b, all amounts held, controlled, or even distributed by a private retirement plan are exempt. This means that you could even transfer certain assets into an existing PRT pursuant to its retirement plan, during subsequent litigation or after a judgment, save fraudulent transfer. The term private retirement plan is not defined in the state code. However, typically, the retirement plan would be sponsored by an employer, typically your LLC, in writing pursuant to an actuarial calculation based upon numerous retirement factors including age. Note that all amounts held, controlled, or in process of distribution by a private retirement plan, for the payment of benefits as an annuity, pension, retirement allowance, disability payment, or death benefit from a private retirement plan are exempt. This differs greatly from other exemption codes in California such as California Codes Code of Civil Procedure Section 704.010 to 704.210, which is the Individual Retirement Accounts, or IRAs. The topic is the IRA. IRAs are not fully protected under the asset protection laws found in federal ERISA protections. However, some states have enacted special but restrictive protections of IRA plans, protecting the funds and distributions only to the extent necessary for the support of the debtor, spouse, and dependents, as in California. The topic is the qualified ERISA plans. ERISA, Employee Retirement Income Security Act of 1974, supplies very effective asset protection over pension funds. The federal law overrides state law to the contrary and protects 401k, profit sharing and pension plans that prohibit involuntary assignment of plan benefits to any creditors. Assets may be transferred into such a plan with known creditors, lawsuits or judgments, save fraudulent transfers. However, ERISA will not protect such assets from the IRS or subject to court order in divorce court, or a qualified domestic relations order. ERISA plans protect employees, but not owner-only plan participants. If the plan's only participants are the owner and his family, spouse or dependents, then ERISA will not apply to protect the funds. This section alone is also worth the price of admission. Listen to it again and consider it as an end goal of all your hard work. The topic is the corporation. The C and S. Corporation. The C corporation is often the best entity for frontline business operations that can afford maximum tax write-offs. Corporations are often used to operate a business with limited liability, and to divide up your business activities for creditor and lawsuit protection reasons. It is often beneficial to segment your risky business activity or assets from your safer activity or assets, or to have certain corporations act as partners to other devices. The C or S corporation may be used to as your frontline business entity, which in this day and age is expected to be sued. The C corporation is often used to conduct business with minimum asset ownership. Certain capitalization rules must be satisfied with legal contributions, insurance and credit. The C corporation is often used to maximize corporate and fringe benefit deductions. However, if C deductions and fringe benefits are not used, the C corporation will be vulnerable to double taxation, once at the corporate tax return level and again at the personal wage level. Like the C, the S is often used to achieve the same level of limited liability protection, but with less fringe benefit tax deductions. However, the S comes with pass-through taxation, which is often advantageous to many clients who expect some losses in the first years of operation or use the S with other devices named herein, etc. The tax attributes of income, deduction, credit and loss are passed through to the shareholder's personal tax return. The S corporation does have several limitations that you must be aware of, including but not limited to 1. The number and type of stockholders, 2. Limited loss deductions when debt is in excess of basis, and 3. The lack of increase in basis due to entity-level debt, whereas the LLC and FLP, LP, does not have such limitations, etc. For example, for basis reasons, an S owner should consider getting a loan personally, not the S itself, as opposed to the LLC, or FLP, which can have the entity itself get the loan and benefit from that increase in basis adjustment. The topic is the Family Limited Partnership, or FLP. This is, or was, a very popular business and estate planning instrument, especially before the LLC. It was used for many purposes, some of which include asset protection, favorable pass-through taxation, ability to control transferred property, as managing member or per the LLC, reducing estate or income taxes, life insurance ownership, and fractional gifting with use of beneficial discounts. Let's talk about the charging order. The Family Limited Partnership will protect its assets from partner creditors. It has a general partner and a limited partner. The general partner is in the 100% at risk position and the non-active limited partners are shielded from liability. It is or was common to have a corporate general partner, with a minor interest, like 1 to 10%, and the limited partners own the 99 to 90%. Thus, the protections inherent therein. It has the power of the favorable asset protection charging order laws. CA. Corp. C15522, 15673, Florida. Stat. 620.22, Aries. Reverend Stat. Ann. 29 to 341, Nev. Reverend Stat. 88.535, NY Partnership Law 111 McKinney, Tex, Code Ann Art. 6132A17.03, etc. However, be aware, in California, effective January 1, 2003, the law changed to allow foreclosure of interests. This is a dangerous change and a blow to the asset protection feature of the charging order. Normally a charging order is the exclusive remedy and will only allow the creditor to obtain certain distributions from the entity, if any, and not the assets. However, in such cases, generally the creditor would receive a taxable event, under Rev. Rule 77 to 137. upon the issuance of a charging order, as constructive income, even if you receive no cash or property. This could be a powerful settlement device. It appears that one should consider opening an FLP, or LLC, in a state that does not allow foreclosure, like Wyoming or Nevada, and then qualify to do business in their own state. Now it is also common to structure the FLP as a family LLC. Let's talk about the Limited Liability Company, LLC. LLC stands for Limited Liability Company. However, if an LLC elects to be taxed as a C corporation, it then stands for Limited Liability Corporation. An LLC is a creature of state statute. It varies from state to state. It most often takes the substance of a limited partnership for purposes of liability, accounting and taxation. Most clients will desire the substance and form as a limited partnership, not a corporation, especially if residential or commercial rental properties or other capital assets are to be held or owned by the LLC. The LLC is the most flexible entity structure. You can create various forms of capitalization, including equity, economic or profits interests, both passive and active. You can have special allocations and percentage holdings, without restrictions to the type of ownership. Generally, all of the favorable attributes of the family limited partnership discussed above apply to the LLC, including but not limited to asset protection, favorable pass-through taxation, Subchapter K partnership taxation, the ability to control transferred property, as a managing member or per the LLC, ability to reduce estate or income taxes, to hold life insurance, for fractional gifting with the use of beneficial discounts, the ability to allow passive investors a voice in management without fear of losing the limited liability status, the ability to make passive investors active without loss of limited liability status, and favorable asset protection with the use of charging order laws. The LLC also allows for use of the single-member LLC and disregarded ownership taxation, through TR 301.7701 et seq., which does not require a separate entity tax return or federal ID number. Also, one key structural advantage is having several single-member LLCs, holding different property or businesses, all held by, for example, a favorable Wyoming multi-owned protected entity. Note that certain cases have allowed single-owned LLCs to be pierced, but that can be counteracted by the favorable Wyoming or Nevada owner of the single-member LLCs. Finally, let's talk about the business or land trust. Is it real and valid? Yes, even though it is not by substance and law an asset protection device because beneficial interest can be reached by creditors. However, it is very useful to hold various businesses or property which can also be held in a Wyoming or Nevada multi-owned LLC, similar to the single-member LLC structure. It is also a disregarded tax pass-through entity. The business trust is often used as an alternative to the other business devices to operate a business and add a level of privacy and potential creditor protection, or used to hold rental real estate. The trustee may be a person not owning the beneficial interests therein. Often family members may be effective holders of the generally private beneficial interests of the business trust. Warning: the beneficial interests may be attachable by creditors. In closing, we end where we start. The most important lesson, contrary to what you may think, is to analyze your business and life, based on its purposes and goals, lines of business and activities, and segregate each into its own entity, trust or device. That's the safety zone. In California, to protect cash and retirement property, we have one of the most powerful devices known as the statutory-styled Private Retirement Trust or the PRT. Well, I think we did it again. Congratulations for watching this video. Now you have to make an important decision. What is the next video you need to watch? Video 1 for living trusts, or Video 3 for advanced clients? You can book a call with Wealth.Attorney, and for a limited time directly, with California attorney, Rydstrom. See the link in the video description or call 877-WIN-4U. Thanks again, Rydstrom, California attorney. Legal notice. IRS Circular 230 Disclosure Notice. To ensure compliance with IRS requirements, we inform you that any U.S. federal tax advice contained in this communication is not intended or written to be used, and cannot be used by any taxpayer, for the purposes of I. Avoiding penalties under the Internal Revenue Code or e. Promoting, marketing or recommending to another party any transaction or matter addressed herein. Any legal advice expressed in this message is being delivered to you solely for your use in connection with the matters addressed herein and may not be relied upon by any other person or entity or used for any other purpose without our prior written consent. This information is for general non-exhaustive educational purposes only. May be deemed an advertisement by the State Bar. All rights reserved in trademark and copyright. Copyright 2022 Rich Rydstrom, California Attorney. Call 877-WIN-4U. Email info@Wealth.Attorney.